Good day, subscribers, and welcome everybody back to The Contrarian. Today I want to talk about several tweets Michael Burry has just put out that I think really could encompass his overall macro statement of the market, where it currently is, where speculation currently is, where valuations currently are, and also where he would say the market is likely going in the near-term future. And this is with a few caveats. Obviously, I'm not trying to provide advice through this video. I'm not trying to scare anybody out there. And I think Michael Burry would definitely say the same thing as well. He's predicted several of the past bubbles. He most notably, he went short on the CDO bubble that essentially was behind the entire housing bubble that was present back in 2007. He did actually go short some high-flying tech companies back in the dot-com bubble, and he actually did briefly go short index funds right before and during the whole COVID hysteria and crash that occurred in early 2020. So that being said, he has been very good at predicting bubbles. He's been very good at sort of acting on that knowledge and things that he can see out there in the market. But in terms of actual timing, he's been saying basically the same statements regarding the market and valuations for a while now. So I think he wouldn't want you to take this as advice either, but more so as sort of a precaution when you're considering making investment decisions in this day and age. So without further ado, I'll get into these tweets and then really kind of dissect each of them and kind of explain what Burry is probably getting at with it. So the first tweet, Michael Burry says that currently in the market there is more speculation than the 1920s, more overvaluation than the 1990s, more geopolitical and economic strife than the 1970s, and players grabbing the barrel of Kyle Rittenhouse's rifle while SEC and the Federal Reserve nod approvingly. And then he references an article by the Wall Street Journal of Rivian, which recently had an IPO just this week, and already they're being valued at $120 billion, and they've only sold 156 vehicles. So again, just an extreme example of speculation and overvaluation. I think this can be seen. Obviously, investors are willing to bid up the price that much because they think that Rivian is going to be able to just, compete with the likes of a Tesla, to where they're already being valued more than Ford or General Motors, and probably approaching the combined value of those two companies, as insane as that sounds. So that's just Michael Burry's perspective on how extreme speculation is right now, how we're essentially at all-time highs when it comes to overvaluation. Compared to the tech bubble, we're higher in terms of valuation on the market than then, and more speculation, and then more economic strife than the 1970s. So this doesn't bode well for the overall market when this does finally begin to be priced in overall. I think that is what Michael Burry is saying. Further on, he references inflation, and American real wages adjusted for inflation are down 2.2% since January 1st of this year, 2021. And then he says, seems the only true meaningful thing that's down this manic year. Inflation is a massively regressive tax. Never forget it. So here Michael Burry's real, I think, Austrian sort of economic side comes out in that, yeah, inflation is definitely a tax that most people do not realize, and especially those who could be more on the receiving end of government welfare programs or a lot of these handouts that have been given out in the last 1.5 years. Oftentimes these people do not realize that printing money does not mean that money comes and it just has no long-term effects. In fact, it does have very long-term effects in that it takes a very long time for these changes to actually be realized out there. And that is one advantage that the Federal Reserve has in terms of printing money and all of this fiscal and monetary stimulus that they've done, is it has a very prolonged and delayed effect of actually coming about. It just takes so long for that money to actually begin to make its way into the market and then actually begin to cause real price inflation And obviously, Michael Burry's referencing that wage inflation pretty much always lags the price inflation. So, right now, essentially, the economy is not in a strong position. Even though wages have risen, they've risen, 2.2% slower than the rate of inflation. So, yeah, the economy is definitely not in a long-term, stable position. If anything, it's in a very unstable position right now. And this ties in with the third tweet Michael Burry put out, just referencing how absurdly overvalued the market is in comparison with all of these fundamentals. Essentially, the S&P 500's nominal PE ratio is currently 26, and Shiller's CAPE is 39.23, and that's the chart below. Neither necessary nor sufficient, but he references that the S&P's PE was 18 before the 2008 58% bear market. It was 20 before the 1929 80% bear market, and it was a 19 before the 1973 48% bear market. And then that was because earnings fell 91% in 2008, and then they fell 73% in 1929. So, despite having really bad economic data behind the overall economy, valuations are extremely high. And I think it doesn't take a rocket scientist to point this out. It also doesn't take a rocket scientist to figure that, well, eventually these two do need to come back together. That is what history would suggest. That is what common sense would suggest, is that eventually the valuations and the fundamentals of the economy need to come back together at some point. And, Michael Burry isn't providing any sort of timeline when this might occur. I'm not trying to provide any sort of timeline of when that might occur either. In other words, it could go on a little bit longer or a lot longer, just depending on, in a lot of ways, how aggressive or dovish the Fed ends up being. I think a lot of it does come down to the actions of the Fed, whether they become a lot more hawkish than might be expected, or whether they continue to be very cautious and dovish. So all of this being said, I hope that this video kind of provides you with some valuable insight into the mind of an investor out there who's been very accurate in terms of identifying and profiting off of past bubbles that he's seen out there in the market. Unfortunately, I do not think I will be able to convince Michael Burry to join me on this show, but I do like talking with other people out there. I'll have a few of them on pretty soon after this, and yeah, I hope that you enjoyed this content. If you did, just consider subscribing, and I hope to see you again at some point.